So you did it. You logged in your first zero commission trades, bought just about anything the Reddit gang could agree on, and if you were lucky enough to ride the Fed's gravy train, you even possibly made a few bucks. Heck, life's looking pretty peachy right now. Trading survival happens to take a little more than just downloading an app though, and fabricated short-term outcomes have a pretty decent track record of being caught up by reality. So if you want to avoid a hard slam back to the mean when the music stops, and not end up like your average Vegas players who dragged on for too long at the roulette table, I have a course for you, and this one is actually free, unlike Robinhood. As a new trader, before learning to excel, you should first learn how to survive. This takes avoiding costly mistakes that you don't have to make if you learn from others. So let's get started. Number 1. Avoid commission-free brokerages. Guys, besides your mom, nobody will wake up in the morning to cook you a free lunch. That doesn't exist. Your so-called free brokerage is actually not free. In fact, for high-volume traders, it may even be a lot costlier than a pay brokerage. Brokerages like Robinhood make money by collecting what is called PFOF, or payment for order flow. Without overcomplicating the process, what they do is sell your orders to high-frequency trading firms who will be more than happy to take great care of your order fulfillment by shaving off fractions of a penny per share. The practice is totally okay with regulators like the SEC, mind you, who passed the so-called regulation NMS in the mid-2000s. This rule ended up causing a slew of unintended consequences, like any regulation does, one of which opened a gaping hole that got filled up by latency arbitrage and essentially ruined your ability as a client to be guaranteed your order execution at the NBBO or National Best Bid Offer. The market for payment for order flow is huge, and of course, the unsuspecting retail client is footing most of the bill, as you can see here. So by paying zero commission to your broker, what you're basically doing is giving them total latitude to dump your order to the wolves and get horrible execution as a result. Of course, the more volatile the market, the higher the bid-ask spread, the more is being shaved off your final execution price. Now guess which broker is outperforming everyone else at this game? You got it. Your favorite so-called free brokerages. Now reflect on what follows. Virtu, one of the largest HFT firms, had only one losing trading day between 2009 and 2013, and it was due to human error. Others like Citadel are feasting over it with a whopping 99.92% winning rates. All of it, of course, has nothing to do with trading skills, but rather with retail fish being taken advantage of over and over. Studies have shown that for every 100 shares traded, the average skimming rates could rise to well over 30 cents, with options trading taking the cake in the rip-off scheme. Now, if you think 36 cents per 100 shares is not much, think about how this adds up over the course of a year. Doesn't sound all that free anymore now, does it? Not to mention the shadow cost that comes with non-existent customer service and incessant platform outages that could potentially cost you thousands. Remember, we started with the premise of a working, fair and free service here. Even the SEC is now trying to cover itself by pretending to crack down on the very firms that it allowed to do so, bringing up the good old full disclosure investigation. You know, as if anyone ever expected clients to actually read the fine print, or that PFOF disclosure is buried deep down 20 pages of legal verbose and appears in a font so small you can barely notice it's there. Where have we seen this BS before? If anything, this fiasco should make you realize that none of these actors are here to help you. Only you can help yourselves by taking in more knowledge and acting on it. The bottom line is this, guys. You want a service? Pay for it. If you want to grow in this business, definitely put the issue to rest and consider going with a pay brokerage. At their price rate nowadays, there is absolutely no reason not to do it. That is what all the pros go for. The math is very straightforward and the savings both in terms of stress and money are immense in the long run. So don't be a cheap shot. Number 2. Stop chasing extreme rate of return. Been there, done that. When you start in trading, it's all about that profit percentage. Does it sound familiar at all? You get that tunnel vision about how much money you're going to make next, so you take on more and more leverage, all the way up to your eyeballs and beyond. And in the process, you're forgetting all about the fact that trading is nothing else but risk management. You overlook the fact that trading performance is measured in terms of risk-adjusted returns and not returns alone. And you keep ignoring it until odds catch up on your account and terminal shit happens. Trust me, the market is not going to argue with what you believe or how delusional you are about being able to outsmart an entire industry with your silly Fibonacci retracements. If you want staying power in this game, the market will force you to look into the unsexy part that demands actual work. This aspect is so important that I have dedicated from the get-go an entire course explaining in this educational series what trading success is really about and how risk management should be at the very core of your trading endeavor. It is a must-watch if you just started. And I'll throw this one last thing in to finish on that subject. This is gonna give you a good idea of how sustainable your results are so far. Excellent money managers pull off a MAR ratio of between 0.5 and 1. Anything above 1 over a few years is exceptional. The implications of what I just said is that by definition, if you gathered a 50% or more return in the past year, and most of it was achieved by following whatever basis you think works to select your trades, then your probability of ruin is basically 100% in the next few months if you do not change anything to your process. Ponder that for a second. And if you still don't grasp what I just said, this is fine, but understand that you have only 3 choices from here on out. Either you level up and learn what trading expectancy is by watching the course that I just mentioned until you finally lower your leverage, or second, you understand that something must be wrong with the way you're going about trading, but you don't want to know more. That's fine too. But then I'd suggest you wise the fuck up and walk away from the table before the dealer takes it all back from you in one go. Or 3, you ignore what I just said, you keep playing and testing how much you can bend the odds until you get pulverized by the few in the market who know exactly what they're doing. I know I'm not mincing words here, but this is the truth, guys. The best part though is that the solution is just a matter of your choice. On to number 3. Do yourself a huge favor and stay far away from penny stocks. This point is actually intimately related to number 2. By flocking to penny stocks, what newbies are looking for is to flip 4 or 5 times their investment in a week. You might be able to pull it off once or twice if you're lucky, but realize that penny stocks are extremely subject to the age-old pump and dump schemes. And there are more bag holders who are maintained by penny stocks than they would care to admit. There is a good reason why these stocks are not listed on regular exchanges. What you're trading with these are very small, sometimes borderline bankrupt companies with nothing but a business plan and shaky promises to back up their valuations. These stocks usually have a very tight float, equally small daily traded volume, and are very easy to manipulate. So in other words, your entire investment rationale here is to hope for a horde of greater fools than yourself to jump in and push the price so that you can turn around and dump the hot potato back onto them. Does that sound like a solid long-term investment strategy to you? I mean, really. And you better pray that it happens, because another fantastic feature of pink sheet stocks is the absurdly large bid-ask spread and associated commissions, which are often denominated on a per-share basis. In plain terms, it is not uncommon to pay a hefty upfront bill for the privilege of getting a front row seat to the shit show. What I'm talking about here is being 3, 5, sometimes 10% underwater from the get-go on your trade, simply because of a bad combination of slippage and out-of-control commissions. Talk about stacking the odds against yourselves. Guys, the game is hard enough like that when you start for you not to add further insult to injury that way. Remember, there's more opportunities than you will ever be able to identify and grab on listed stocks, and there's absolutely no reason for you to hunt in these muddy waters to drag dinner back to the hut. Moving on to number 4, don't overspend on your trading station. Be sensible about it. Your bankroll likely still is in the thousands, if that, and you are most likely not running any resource-hungry algorithm that crunches boatloads of data on a daily basis. Just like you don't need a nuclear bomb to kill a rat, you don't need a home super server to plug in a few free indicators on a chart. What that means is, keep it to one single screen and one computer tower or laptop with an entry-level processor. Full stop. That's all you need when you start. If anything that makes you happy, get more RAM like 16 gigs to comfortably run a few apps at the same time, but that's already pushing it for most beginners' use cases. Don't be like all of these social media clowns flaunting their crazy setups and pretending to be professionals just because they can show off more screens, bells and whistles that they can't even afford in monthly power bill. More equipment is not a substitute for a brain, willpower and knowledge. In fact, you will find very quickly that it may even detract from your progress. Because trust me, if IT problems are not taken into account in the list of issues issues that you deal with as a trader, then I can tell that you have not been trading long enough to justify spending more on equipment. When you get there, believe it or not, IT problems are the number one issue you will encounter once you turn professional. And as a pro, you cannot afford it. You need to keep your focus on accuracy, research, and consistency, as opposed to flashing LED lighting as an ego boost. The rule of thumb is the following: if you don't already have some equipment, spend no more than the greater of $500 or 2% of your bankroll. The most I ever spent on a trading setup is $3,500. I did it after 16 years in the industry, well within becoming consistently profitable, and while I already traded several millions of dollars. You want another nugget? I trade most speculative markets, and all I have is one screen. That's it, one. But nobody's gonna tell me that you somehow need more than that as your skills and scale expand. No, you don't. What you need is to consider trading like the business that it is, and every expense has to make sense in how quickly your return on investment is going to amortize it. Most newbies will spend 1, 2, 3 years or more of ROI on a trading setup. This is madness. Do you want to make money, or do you want to impress your broke buddies who don't know better? So don't let yourself get carried away. The market does not give a crap about how cool your desk looks like. Number 5, opt out of pseudoscience as a basis for trading. Let me get this point across again. There is such a thing as negative knowledge that not only will not make you progress, but that will also keep you back. For newcomers to the trading arena, it is worth repeating why it is so important to be critical about the pseudo knowledge spread out across most, if not all, trading forums and online education. Think about all the strategies that you have browsed so far. As you will recon, just about every single one of them revolves around the same tired concepts that never made you a dime. To name a few, the rule of thumb is that anything related to trading mindset or psychology, randomly slapping indicators around for the sake of them, pattern recognition, price action, drawing lines, retracements, support and resistance, candlesticks, and all of this preschool junk needs to be tossed for the trivial nonsense that it is. Trading is much more brain intensive than these guys. I am not saying that it is overly complicated, that is by no means the case, but it is complex and it demands work. Ask yourselves, for God's sakes, if all it took to succeed was drawing a few lines on a chart like a 5-year-old, then why in hell would the top hedge funds invest so much in research and computing power? There is a reason why the proponents of these concepts cannot show you a profitable track record, or why you are so confused as to whether you are applying the method properly. Because it relies on relativistic, perceptive artifacts that cannot be proven nor disproven, nor consistently replicated from one trader to the next. The reason why you're not succeeding with these methods is because it is impossible. Plain and simple. These concepts are void of any mathematical sense. But hey, you're free to challenge what I'm saying. Let's meet again in 3,000 trades from here and check your stats then. We both know the outcome already. Moving on to number 6 now. Don't rely on your fancy degree to propel you into trading profitability. So you think your fancy Ivy League finance or math degree will get you there in trading? Not even close. And this one's a hard pill to swallow. After all, the teachers are the experts, right? How do they call it again these days? Oh yeah, they represent the peer-reviewed authoritative source. So they gotta know better, correct? Well, not quite. The truth is that you cannot expect anything groundbreaking as to the know-how of the matter from scholars who reflect on theories in a vacuum chamber and are more concerned about their tenure and funding than they are about shaking the tree of knowledge and breaking the status quo. That's why the value proposition to you as a student will mostly make as much sense as the debacle that led to the outrageously disproportionate positive results drawn from PCR testing. I am seeing so many fresh out-of-school students who think that with what they know, all they need to do now is push the buy and sell button and off they go to $1 million. This delusion is actually tied to one cognitive bias: the cult of authority. You went through a socially renowned institution that's vetted by government, therefore you're gonna know better than average, right? That's how it goes. Let me tell you one thing, the market's gonna be very quick to remind you that science is not validated by social status. Just because these institutions slapped an Ivy League branding on your degree that make mom and pop sprout around their friends during Sunday's barbecue, and just because these schools demand that you recklessly pay through the nose for the privilege of getting what amounts in the end to nothing better than standardized, state-sanctioned educational material, does not mean that you took away anything of value for your trading career. Sure, you will know what the Greeks mean, but for the most part, the only provable takeaways from these programs are 1. Gathering high transgenerational debt for yourself, and 2. A hardened ego that will keep you from progressing because you're convinced that you know better just because you've got the pedigree. Hear me out here. Nothing in these curriculums will help you advance your trading performance significantly, and certainly not even close to what you put in terms of time and expenses. The only base concepts that you need to power through in your trading education amount to some knowledge of statistics and calculus, and especially an intense drive to be obsessive at the task to the point that you will get your friends and family worried about your mental health. Because what you need to succeed in trading is to gain a kind of knowledge differential that can't be met with standardized concepts that everybody has. Ivy League degrees are a total waste in that regard. All that they truly provide you with is a pass to be accepted for a position where some entity will grant you a license to operate as a compliant corporate drone, none of which has anything to do with what's required to trade successfully. How do I know this? Because I have 2 of these flashy degrees, and I know better than to brag about them or put a fancy title in front of my name like a low achiever in need for social recognition, because I know better. And I know that they're 100% useless when it comes to trading. You see, I keep pouncing on retail trading education, but for what it's worth, I do think that this Ivy League-induced snobism might actually be even worse in this case, because at least with retail knowledge, the upfront deception is not there, and you're not assuming that what you're reading or learning is of any significant value. Plus, most of it is free, contrary to these insane tuition fees. So if all you want for the future is trade successfully, don't waste your time and money, and don't fool yourselves. Or the market will remind you that there is a very real reason why teachers can't trade better than their students. Number 7. Don't chase the next trading tip. That's right. Leave this one to the average gambler. Now, just for kicks, how many times have you had someone during a family gathering ask you, "So what's the next thing I should invest in right now?" If only I had $1 for every time this happened to me. And my answer is always the same. I have no idea. Now watch their face melt. It works every time. It is as if 3 snake heads suddenly grew behind my neck. Do you know why? Because most people's approach to investing is based on the premise that you somehow have to be so-called in the know of what's hot, to jump from tip to tip on your way to becoming a millionaire. Want to see how that works? Well, go on trading forums or look up some trading tweets. It is all about the next tip, whereas trading, when done morally and legally at least, is the exact opposite of that. Quantitative trading in particular is about repeating every day the same process that will generate in the end, meaning after thousands of trades, a positive expectancy. Yes, in trading, contrary to what you're hearing everywhere, quantity matters just as much as quality. There is no cherry picking involved, ever, because cherry picking is essentially betting on your ability to predict the future. And of course you can't do that. In fact, cherry picking also happens to be the best way to sabotage an otherwise perfectly profitable trading system by breaking its consistency. Don't get me wrong here though. Information asymmetry does happen, but rarely does it for longer than microseconds around news events, and certainly not long enough for you to be sufficiently equipped to take advantage of it, let alone making a living off of it. As for that random guy online having the tip that will make you catch the next penny stock at the bottom before a 1000% surge, you can choose to believe that, but I grew out of Santa Claus a long time ago. Once again, guys, solid consistent trading is about a chain of trades revealing profitability using the law of large numbers and nothing else. So if you do not have that science down yet, do not rely instead on lousy substitutes that will do nothing better for you than expose you to scams, losses, and possibly legal actions in the worst case. And let's wrap it up with number 8. This one will be quick and straightforward. Actually, it's not a piece of advice, more like an order given to new traders because it is so crucially vital. Do not sell naked call options. For the love of God, don't do it. And no, I'm not talking about trading options in the shower. I'm talking about destroying your financial future because of venturing into something that you know nothing about. Like this young man who tragically ended up committing suicide over what seems to me could have definitely been triggered by such a trade. Many newbies, for some obscure reason, got readily approved for margin trading by platforms like Robinhood. This is a mystery to me, but whatever. What this does is that it also gives you credentials to trade options, which can be a powerful risk management tool, as well as a recipe for utter disaster when put in the wrong hands. Because yet again, all that the beginner sees when touching options for the first time is leverage, leverage, and more leverage. That's it. Selling naked calls in particular has a perverse risk profile, which is that it can potentially create infinite losses that can way surpass the initial nominal value of your trade and possibly your account as a whole. And if you count on your broker to cut the position for you or wipe the slate clean once done, you are in for a rude awakening. Look, the focus of this course is not about the intricacies of selling options. Yes, I know, there is a way you can do it safely by holding the underlying. Nevertheless, take heed. By default, when you are a beginner, your best bet is to choose not to sell call options if you have the slightest doubt about what you're doing. Period. We're potentially talking about terminal mistakes here, guys. Please. So here we are. If you made it to the end of this video, congratulations. You already outperformed the vast majority of aspiring traders out there. A decent attention span is a rare commodity to behold these days. Following these 8 simple guidelines will keep you far away from trouble and dramatically increase your chances of survival. Remember, this first series of educational videos is all about keeping your account out of harm's way so that it is not destroyed by the time you learn how to properly make money trading. Now, if you think this video could help some of your trading buddies, definitely share it with them and consider subscribing to this channel. A lot more disruptive trading knowledge is coming your way in the coming month. Until the next one, stay alert and trade smart. Talk to you soon, guys.